Hi everyone, I'm Karunya Rao and on Ideas for Profit today we talk about a consumer durable contract manufacturer, Dixon Technologies. The company has been riding the industry tailwinds for the past several quarters. Driven by a favorable consumer backdrop, the company has delivered another earnings beat in the final quarter of FY21. Revenue for the quarter gone by rose to 2,110 crores, up 146% YOY, owing to strong performance across all business segments. EBITDA jumped 46% YOY, but the gross margins and operating margins contracted on account of adverse product mix, commencement of new mobile unit, and a steep increase in input costs. For Q4, the top line was led by blockbuster performance in consumer electronics business, which is the TV division, which nearly tripled YOY. Given the Make in India policy tailwinds, Dixon is expanding its TV unit production capacity from 4.4 million units to 5.5 million units. The expansion is expected to complete in Q3 FY22 and has a potential to cater to 35 to 40% of the domestic market requirement. The lighting segment also sustained business momentum and delivered an impressive revenue growth of 50% during Q4. With LED bulb manufacturing capacity of 300 million units, Dixon owns nearly 40% of the domestic manufacturing capacity and caters to all the large brands operating in the industry. To expand the business scale and enhance technological capabilities, Dixon is planning to pursue the PLI scheme for LED components. Also, the management is actively looking at opportunities in the international market. It already has started exports to the US and Indonesia, although in a small way. Revenue growth in home appliances was also led by a strong volume offtake. The fully automatic top-load washing machine plant in Tirupati is expected to start commercial production later this year. The trial runs are underway as we speak, as the company has already signed Bosch as an anchor customer. Meanwhile, mobile phones and EMS division got a significant boost from the scale-up of new business verticals. Dixon is in fact eyeing exponential growth in the segment. It has also recently entered into contracts with Motorola and Nokia for manufacturing mobiles under the PLI scheme. The company is looking to expand its portfolio further by entering into manufacturing of refrigerators. It has already applied for PLI in IT hardware and is also awaiting the final outcome of its application. Dixon is also evaluating the final details on the PLI scheme for lighting and AC components. Given the disruptions caused by the second wave, Dixon's business has come to a near standstill over the course of April and May. However, the management is upbeat on a sharp demand recovery over the next couple of months. Improvements in working capital along with the capital infusion from the QIP has enabled the company to strengthen its balance sheet. The liquidity position is strong as the cash balance exceeded the debt drawn to fund the expansion of manufacturing units. Dixon's all-round performance reassures investors that the company is being steered in the right direction towards long-term sustainable growth. The solid set of results indicate that the company's growth momentum is very much intact and is far from fizzling out. With commodity prices on the rise globally, margin pressures are anticipated to persist for the next few quarters. From an earnings perspective, FY22 could be another strong year for Dixon Technologies owing to commencement of new manufacturing capacities, especially mobile PLI and addition of new clients. The positive earnings outlook appears partly priced in as the stock is trading at a superlative valuation of 58 times of FY23 earnings. With momentum on its side, the stock could see further upside on the back of large untapped opportunity in the consumer durables market. However, investors should remain watchful of the developments in global equity markets as the stock valuation is getting ahead of itself over the short term.